Good afternoon, everybody. Welcome to Trader Merlin Show. Hope you had a fantastic weekend, did something fun, and are ready for wild and exciting markets. Of course, as the debt downgrade was kind of done late on Friday, I thought I would dive a little bit deeper into that to see if this is in fact a big all nothing burger or if it has some serious impact for our markets going forward. So welcome, everybody. Welcome to the show. All right, let me go to our headline here. Downgrading America's debt. At surface level, it sounds terrible. And it's certainly not a great thing, but I think many people, oh, my back sucks, Big Eb. It's bad. So I'm squirming in this seat. As soon as it's done, I'm going to do the ride up and go lay down again. But I had a friend in town for the weekend, and I probably did a bit more activity than I should have. I just sucked it up and went and had some fun. But yeah, my back's suffering today. Hey, hopefully we'll get it fixed this week. Just more heating pads and relaxing is what I need to do. But thanks for asking. I appreciate it. So in the grand scheme of things, having one of the rating agencies downgrade you obviously is not a good thing, but many people are questioning or making the comment, which I agree with, is this just kind of catching up and keeping with the Joneses? Because if you look back historically, we've had multiple downgrades of U.S. debt in the past. In 2011, you had Standard & Poor's downgrade us from AAA to AA+. In 2000 and, what was that last one? I want to say 2023. Yeah, 2023, Fitch downgraded. I remember that was a big hoopla too. Everyone's like really freaking out. But it didn't really do much. And that was downgraded from AAA to AA+ as well. And then, of course, Moody's comes out and downgrades us from a different rating, they're AAA to AA1, which is the same thing. So it's almost like at this point, Moody's is recalibrating and saying, okay, well, everyone else is downgraded. Doesn't look very positive. Let's just go ahead and downgrade for now and see what ultimately ends up happening. So what I thought I would do is bring up the last few times that we've had big downgrades by S&P, Moody's, and Fitch. And there is another rating agency, but no one really pays attention to them, and they've downgraded the U.S. debt several times. So let's go look at the S&P 500 here. We'll go to the SPY. Actually, let's do SPX. So I'm going to zoom out here. I'm going to go to a weekly just so I can get that big picture here and show us more time. And the first big downgrade was from Standard & Poor's back in 2011. So I'm like almost off this chart. But let me zoom over here and get into 2011 so we can see what actually happened when that downgrade came through. That was on August 5th. So I'll put a little vertical line here on August 5th. And the reason I'm doing this is I'm a big believer in, markets have patterns. Markets digest information somewhat similar. Now, there is your big vertical line, which is actually the beginning of week of the 8th. So what they did is they downgraded on the candle before it. So let's move that over to there. It was the Friday right here where they downgraded it. So over the next 3 weeks, if you go from the date they announced to the lowest point, actually it was about 7 weeks. The market had dropped 7%, 7.1% to be precise. And then if we look forward, okay, big deal, right? A nothing burger, as many of you would have called it. Our next big downgrade, shot of tequila. Our next big downgrade was in August 1st of 2011. So interesting, all right around August, but let's go ahead and look at that one as well. 2023. Let's go over here. There's 2023. Okay, we'll zoom into 2023, and you can probably see it on the screen there. During this sell-off here is when it happened. So there was a downgrade. August 1st, which is right there. And from that point to its lowest point, NASDAQ sold, or the S&P sold off in 3 weeks, total of 4.75%, and then proceeded to go absolutely nuts and rallying incredibly aggressive. All right? So now you look out there today, and where did we get our downgrade? Well, I'll move it over to this vertical line. And that was that Friday. We're actually up for that period of time. So this is completely different than what we've had the last 2 times. And as I've heard many of you mention this, that you thought it was kind of a nothing burger and a non-event. That's what the markets are saying to this. It's like, who cares? Big deal. You should have done this a while ago. You're just playing keep up with the markets. So for those who sent in questions asking how I think it's going to affect the markets, all things being equal, it should bring the markets down, but we become desensitized to it. I don't think the market really cares at this point because they already have been downgraded by the other 2 major rating agencies. So, about time that Moody's does this. Now, the big question is, do they get downgraded again? Rawls, a strategic algorithmic pyramid, not poor. Okay, I'll go with that. Is this the beginning where now all three agencies have downgraded one level? Do we get to see them downgraded again? And that would be I think that would be a big detrimental piece if you saw someone drop it one step lower than current. So basically we're a step lower from prime. If you want, I can bring up, let's go bond or credit ratings. Let's go list. I want to go credit ratings list so I can just see the whole list of them all. And that way you guys can see them on screen as well. So here we go. So here's this is from ResearchGate. I'm just bringing up the first one I can get here. Come on. Well, this one does not want to pop up. And of course, it's not there. All right, so here's your ratings table for what we are. And you can see number one, this is the best. This is the highest level that you're going to get, absolute apex. We're no longer there for either one of these three rating agencies. We're at step number 2, which doesn't mean that we're garbage. It doesn't mean we're trash. I mean, really, if you get into the Bs, then you really start to look bad. So we've got a tremendous way to go before we even get remotely close to a point where people are like, I don't trust U.S. government debt. Basically, the reason we're not sitting at that prime level is political, right? We've got way too much debt, and then we have our current elected officials on Capitol Hill battling back and forth and arguing about debt ceilings, about taxes, about a wide variety of issues, which stalls things and doesn't really come to any conclusion or decisive finish on items. So that puts us down, and I think that these agencies were right. I'm surprised it took Moody's so long to drop down to that level of AA1, whereas the others have already been there for years. Now, again, I even think if we get another downgrade to AA's, not the end of the world. But if we get down into that level 5 category where it's kind of that mid-upper grade, then I think people really start to have a little bit of an issue with it. Yeah, Margaret says the Big Short had a scene with rating agencies. If you think about it, they do wield a lot of power, don't they? I mean, they have the ability to drop the rating on someone's debt, whether that's the government or corporation. And if that happens, if your rating drops, then typically what would happen is your cost of your debt would go up. So let's say you're the United States government, and this is that domino effect we talk about. Let's say, hypothetically, that we already have a downgrade from number 1 position here, which is prime, and now we're high grade. So let's say that S&P comes out next month and says we're going to downgrade it to AA. What psychologically happens here? Well, from a debt perspective, it means that there's people are perceiving more risk for government debt, and the more risk that there is, the less likely people are going to go buy that debt, unless they're incentivized, right? For higher risk, I want higher reward. So you're no longer the best of the best out there. If you are going to give me a better rate, maybe I'll buy it. And this could cause rates to increase over time, but it's not something that I think is going to create a monster knee-jerk reaction in this market. So that was the basic rundown there of your downgrading America's debt. Yeah, sure. It was a pretty big announcement on Friday, but it's already been done by the other 2 rating agencies, which is Fitch and S&P, all the way back in 2011 for S&P. Fitch was 2023, and Moody's just did it on Friday. So I do think, personally, well, actually, let's do a poll, shall we? Let's start a poll. Let's see. Will we get another U.S. debt downgrade in the next 12 months? Yes, no. The third option was I don't care. All right, here's your poll. So click on that poll, participate. It's just fun to see what you guys are thinking. Again, there is no right or wrong answer. It's just perception and what you think about our government and how they'll respond to a certain situation. So I put yes, no, or just don't care is your choices out there. Remember, you've got a pretty volatile president in President Trump. And it's kind of like, I believe that other rating, okay, this is just my take, guys. I believe that other presidents have let the rating agencies do what they're supposed to do, which is objectively analyze the markets, come up with a rating for whether it's corporate debt and U.S. government, municipals. They issue the debt ratings. Most presidents, don't whine and complain and point the finger and shout and insult like President Trump can do. So it kind of makes me feel like if Moody's or Fitch or S&P downgrades U.S. debt again, Trump will unleash a tirade of attacks on him and maybe even threaten their business somehow by cutting off different, accesses to capital or whatever it may be, political, stonewalling, anything they want to do. So we're in a very different time. Garfield says, we hope not. Yeah, I would hope not as well. But, looking at our current government, and again, this is not a Trump thing, this is the accumulation of all of our presidents, it's reckless spending. We've just got way too much spending. I was watching an interesting video today of, was it Robert Kiyosaki, Rich Dad, Poor Dad? And he's got this nice little matrix, which is exactly what I'm writing in my book as well, is, your personal wealth, your net worth growth boils down to 4 categories. It's really 3, but one has 2, a subset of it. Expenses, income, and liabilities. So you have assets and liabilities, something that you call an asset. But, for example, your house, while we call it an asset, it's a liability because you're still paying the mortgage to somebody else. It's something could happen to it. It's technically a liability, but people keep it as an asset. So if you have a certain amount of income and your expenses far exceed that, you're going bankrupt. It's just a matter of time. And we have been going bankrupt forever and ever and ever and ever and ever. I think President Clinton was the last one that actually had a budget surplus, if I'm correct. I believe that's true, that he was the last one to have a budget surplus. After that, we have just been continuing budget deficit forever and until something radical happens, which I think Doge was a radical move to make that happen. We're still going to run closer to that debt cliff, if you will, where at some point we know we just can't turn back. So I would hope not, Garfield, but at some point in the future, if we continue this path, those agencies, I believe, have a responsibility to downgrade the U.S. government debt. Imagine if they got downgraded again, what would our 10-year bond jump to? Right? If we look at that 10-year bond today, let's bring that chart up for you guys. Here's your 10-year bond. Let's put on a daily time frame. We're sitting at 4.44% right now. I'll call it 4.45. If they were to downgrade that debt again, let's say S&P came out and decided to downgrade it, I think we would be back above this 5% in no time. Going back to this peak we saw here on January 13th of this year, I think you'd surge rather quickly, because if you downgrade them again, what you're going to end up getting is people starting to back away from U.S. government debt and looking for something that might be a little bit safer. Now, the tough part is what's safer than U.S. government debt, right? Government probably is not going to go bankrupt and default on their debt. They'll just print more and more money, which devalues the dollar, right? So you're buying bonds with U.S. dollars, but the value of your dollars are dropping. You'll lose some of the interest that you're gaining on that one. Andre says politicians have kicked the can down the road. Absolutely. I think that should just be a synonym for politician. Is kick the can down the road and don't get anything really resolved, regardless of political party affiliation. So there you go. Let's see what the result of the poll was. End poll. 45% of you said, yes, we're going to get one. 51% said no, and 3% said, I don't care. I do care. I definitely care because it's going to create big waves in the market, and it may be one of those catalysts that just creates gigantic waves. And I like those gigantic waves, so I definitely care. I'm going to put myself with you 51%ers and say no. I don't. In the next 12 months, I think if you're going to downgrade the debt, something drastic would have to happen. Right now they're working on that big, beautiful tax plan. I guess over the weekend there was some good news there, right? Some officials voted for. There were some, I guess, ultra-conservative Republicans which were against this, and they're now supporting it. So that's a big hurdle to overcome, but we still have a ways to go before we get this tax bill to go through. If that tax bill does go through, there's changes coming. We might be paying less taxes in some areas, but they're going to have to make up that shortfall and then some by taxing other areas or pulling away from different, I don't want to say entitlements, but different pieces like Medicaid for the elderly, Social Security. There's areas where they're going to have to get that money from to shore up that shortcoming. So that was, another positive piece that we saw come out over the weekend. And then today, I didn't listen to it. I just saw some of the highlights. I'd like to listen to it as much as I can, but I've just been too busy. Probably the perfect thing to do while I'm laying on my back. It was Jamie Dimon's Investor Day, or JPMorgan's Investor Day. Now, Jamie Dimon said some things at that conference that I think are noteworthy that we should kind of pay attention to. And one of those is the attitude of the American people right now. And he said, and I quote, He says the market came down 10% and back up 10%. I think that that's an extraordinary amount of complacency. I like that. For him to say complacency kind of does make me reaffirm what I feel, which is the markets just don't care about whatever the tariff impact may have been. They're looking at the future and not taking into account that those tariffs have yet to really hit us from an economic data perspective. Now, they weren't full-blown tariffs, right? We just had some tariffs there, but nothing was fully implemented and heavy like the 145% on China, etc. But there's definitely going to be impacts. One of Trading Academy students who actually takes my crypto program, he works at Port of Long Beach, and he says, we're just dead. There's nothing going on. Now, I assume that that's changed over the last 5, 6, 7, 8 days, but no one's making those big purchases because by the time that boat gets to port, I might have to pay a big tax. So people are holding off, not just buying, but just waiting until this is all done, right? So he said that complacency, or he mentioned that complacency comment. I think there's an extraordinary amount of complacency makes me feel better about my assessment because I think so too. I think that the big data points have yet to drop, although the path right now looks very rosy. If I bring up the S&P 500 here, let's go to that SPX. Show you that one. Margaret says Realtik. Realtik was actually an institutional platform, a trading platform, run by Townsend Analytics out of Chicago. Loved it. Great platform. It was really like CyberTrader was great. Realtik was a great one as well. It was one of my favorites, but they got bought up by a big corporation that took it and kept it more for an institutional shipping platform or trading platform. So yeah, I just got the t-shirt, nice and comfortable. No marketing dollars spent for marketing Realtik. I don't think you can get their platform anymore. But it was pretty robust. I actually got to help with the development a little bit on them, so it was fun. Good times. What do you guys got coming in here? The Brooklyn Bridge thing, that was nuts. He says the Brooklyn Bridge has to collapse in order to get another Moody's rating down. Knock on wood. And yeah, that was bad. That was bad all over. Well, I still have not figured out or watched to see exactly how on earth could that possibly happen. You know exactly the height of the mast, and you know exactly the height of the bridge. Like, how do you miss that? That just seemed absolutely crazy. Oh, man. Oliver says, that means ships are waiting with cargo at sea like COVID. Yes. Right? And I would assume, well, Oliver, it does, but, okay, let's all pretend that you guys you're Nike, and you run a multinational corporation, and you need to get your shoes from China. So you already have your orders in. So the China is already manufacturing these shoes, and they've put them on a boat. If they put them on the boat and the tariffs are really low, you say, okay, get it to port. If they put it on the boat and it gets to port or gets outside of the Long Beach port, for example, and the tariffs are still at 145%, you're like, wait. Remember, every day that you're waiting, they're charging. That's cost of business there. So, I don't know. The ship had a mechanical problem? Oh, boy. It was pretty bad watching that boat crash like that. I felt really bad for them. They're all patriotic and doing a real pride for Mexico thing and just train wreck. Train wreck. What else? Lisa, how many people can really afford to trade the stock market these days? I think that most who trade will not hurt as much from these changes as those who cannot afford to do what we do. Right, Lisa, which is why we learned to trade, right? I feel like I'm being overly rude or hypocritical when I say things like, if the market crashes, I'll be happy with that. I mean, the average person's going to hear that statement and be like, you're a jerk. Yes, it's a self-centered attitude. But if I know how to profit from when the markets sell off, why wouldn't I be happy? And actually, they move faster to the downside. So yeah, I'd love it if the markets tanked. Allow me to buy into some things at cheaper prices. You know, today I made some trades. I didn't go as heavy as I wanted to, about half of what I thought I would want to do just for weekly trades to generate some income for the week. But, you know, if we go lower, great. I'll set some prices at lower levels to buy it. So most people, you're right, will suffer and pay the dues when this economic data comes home and really hits hard. And when's that going to be? 3 months, 6 months, 8 months? I don't know. Louis says, since COVID, the market has been a lot of retail investors. I don't think it's just retail. It's still driven by institutions, Louis. It's driven by institutions who have algorithms and programs written for trading. Most of it is computer-based, which is fine. Like, again, I don't care who's on the other side of my trade, whether it's a computer algorithm or anybody. It's just I'm playing my strategy the way I read these swings in markets, whether I'm using patterns, candlesticks, just looking at price momentum. That's all I really care about. So you say you think more retail investors is changing the way institutional investment works for bear markets, where retail investors see a big drop and just buy. I think it's the other way around, Luis. I think when you get a big drop, that's when retail investors start to panic and institutions buy. Institutions have the ability to stop a market from falling. You and I don't, right? There's no way that I'm going to put enough buy power in there to stop the S&P from tanking. So what I believe is that this market is manipulated without question. And what you get are these really big down moves, blow-off moves like we had on April 2nd, April 3rd, 4th, and 5th, where markets drop significantly. That's retail investors panicking. And then institutions come back and buy it and end up driving those prices back up. So it's always that battle between retail and institutions. Retail typically loses just because we don't have the ability to move markets ourselves like Warren Buffett does, or Ackman, or JPMorgan, or Larry Finch of BlackRock. Tomlinson says the statistics from our treasury, top 10 have 88% of the equity, top 40 have 12% of the equities, the bottom 50 only have debt. Ouch, ouch, ouch. This is why you educate people. You know, if you got a family friend or something, educate them about money. Because to Thomasina's point there, and I know she's always studying and getting all these statistics for her reports, I'm sure, top 10% have 88% of the equities, meaning they've got 88% of the wealth. And that number, I actually think that should be higher than the top 10. But at least what I feel for, is those people in that bottom 50. If you break that down, Thomasina, you broke it into 3 tiers. The top 10% have 88% of the equities. The top 40% have 12%. So you've got the top 10%, we'll call it the upper 30% or 35%, and then the lower 50. We're not worried about the middle upper 30% or the 1% is that top percent. So really it's the 50% and above is fine. Those people will probably do well over time. The people that I think miss out the most, and the people that suffer through this, is that bottom 50%. And you guys tell me, why do you think that 50% of Americans are not involved in the stock market and only have debt? What would you say is probably the most logical reason for that? And people will point the fingers at oppression and lack of jobs and racism and things like that, but certainly lifestyle is a big part of it. Education. Yeah, but ignorance, Eric, I would say ignorance kind of falls into that you don't know what you don't know kind of thing, right? The underprivileged, I think, that bottom 50%, my assumption is they're driven by what they see on TV. And they've got to, if they have a choice of taking a class on money management and budgeting, they'd rather go buy themselves a new watch so they can look cool because all the ads have it. So I think the media has done a tremendous job of pushing these people to buy stuff that they just, number one, don't need. Number two, they can't afford, so it puts them in more debt. And then they will never get their head above water. Whereas, I like Scott Bessent. I got you, Eric. Scott Bessent is making a push right now for education for the U.S. And you guys might remember last year sometime, this is before the election, well, long before Bessent was even a consideration, I talked about if I could make one rule, it would be mandatory that every American, by the time they're 18, would have to take a class on personal money management, on personal finance. Then we would change that whole curve, that whole statistic of 50% of Americans, not having any stake in the stock market to build their wealth. That would start to shrink. Now, you'll always get people that don't want to follow the rules, that don't have a plan, that don't care, and they just spend. But then I think if you can take even 10% of that lower 50, you change people's lives dramatically. Awareness, education. Andrew says lack of savings. And you're right. So in some cases, those people have nothing saved. They're living paycheck to paycheck. And what they need to do is immediately look at everything they spend their money on, which is, get an app or something that tracks it. And if you're making less than you're spending, you'll never be able to make it. Lotto is your only chance of surviving long term. And government handouts, let's put it that way. But if you can change your lifestyle, maybe earn a little bit more money or cut expenses and get that to where you're positive, then you have hope, right? And now it's what do I do with the money? And most people, when they do have extra money, go buy it and spend something with it as opposed to invest it and watch that capital grow. Yep, Thomasina, education, mismanaging their money, lifestyle, all that stuff. Yeah, it's good. Big Eb says the bottom 50% will also get the largest tax increase by percentage if we don't get this tax bill done. And what is that going to do? Make it even worse, right? The Every Dollar app is a good way to start. I use one. It's just called the Expense app. I've used that one for a few years now. Don't need to pay for them. You can get these apps for free. I'm trying to look at the icon for the one I have. It's called the Expense app. So I do it once every few months. So what I'll do is on a like first of the month. So I'm actually doing it this month again, where every day I tabulate my expenses. So if I go and buy anything, I write it down in this app or just input it in this app. And as the month goes on, it'll tell you what your income is and what your expenses are. And my goal is not just to make sure that my income is higher than my expenses, but I really want to make sure I analyze it and figure out where I'm spending all my money. All right. So for example, this weekend was the entertainment category. Had some significant spending in it because I got a good friend in town. We're going out and going to dinners and drinking and just having fun. That's an outlier for me. I normally don't spend that much, so I'm tracking that. But yeah, everybody needs to do that. Everybody has to do it. Investing has more taxes than consumption. Yeah, but investing has growth, consumption has not, right? Consumption is you're just deleting money from the system, whereas investing, you're growing it even though you might be paying more taxes. Eric said, put everything into Quicken. Yeah, you tip an extra $1, put it into the spreadsheet, whatever it is you're using. Bank of America has that automatically for each transaction across accounts with credit cards. That's if you connect everything, right? I have different accounts all over the place. So I've got some Chase, I got Wells Fargo, I've got Discover, I've got them all over the place. I get Citibank. So this app allows me to put it all in one spot. All right. Garfield, that's great. I know where my spending goes. My husband buying things online. Oh, the gender reversal there, right? Usually it's the ladies spending all the money online. But no, the men, now that we've got that Amazon app and we can just click a button and have it sent to my house by tomorrow, it changes everything. It's funny, a friend of mine, he lent me one of these little, I don't know, electrical things you put on your back and it spasms your muscles to make them feel better. So he let me borrow that one and it was great. So literally when I'm laying there getting electrocuted by this thing, I ordered one to my house. It was delivered 5 hours later. Love it. Yeah. I haven't bought anything on Temu. I don't know if I trust Temu, but I've heard people say good things about it. All right, so when you look at Jamie Dimon's comments about complacency in the market, it should just give you a little bit of pause, and not to be, as Oliver will call me, the purveyor of doom and gloom, but this move we've had up is just crazy big. I mean, this is a pretty phenomenal market move. I like Jamie Dimon said we've gone down 10%, up 10%. Well, that's not true. We've gone down 25%, I think, or 27 was the biggest drawdown we had. 21% slide and a 23% to the upside. So yeah, absolutely big irrational market moves. And I believe personally that a lot of people are just shrugging off anything that might be bad right here in this move up. So, the bullishness in me says the trend is your friend right now and things are starting to calm down. But I don't believe that we are fully out of the woods yet. Again, data. Thank you, Jerome Powell, for emphasizing data on every single thing that you do. All right. So that was Investors Day. I'm going to probably go watch that presentation later tonight or later today if I have time when I just lay there in my room. All right. Next, let's go through our top 8, and then I'll walk you through some of the trades I made today. Again, those were I would call them half-mass trades where I just didn't want to do the whole thing. It wasn't a down day to remember where I was going to get great profits. Even though, last night when we rolled over, the S&P 500 was already down like 0.7%. I was like, oh, we could get a good pullback on Monday. Started off pretty weak, ended actually really strong. And I think, John mentioned that one right at the very beginning of today's program. He's like, man, today's market move fooled the pants off everybody. I don't know if it necessarily fooled them, but it certainly was the opposite of what most people are expecting. And I'll bring up the S&P 500 here on a 5-minute time frame to check that out. What you see in blue is the market opening or closing on Friday, but opening Sunday night. So there's your Sunday night open, and it just started to drift lower and lower. And right around 1 o'clock in the morning, it started to rally back up. We opened up with a fairly down market and then just had a really nice run from there. And we're moving up here in the after hours. So things looking great right now for the S&P, which is fine. The positions that I opened up today, and then I'll go to my top 10, or top 8. I took chances. I took a lot of chances this week. I wanted premium, and I didn't see a lot of premium in markets that I wanted. So I did a small position in United Health. I know that this is just absolutely wild, and you guys are like, what the hell are you doing? Premium was really good. Got about 1.5% for the week, and I believe my strike price was $350, $340. Hold on, let me look and see that. I forget the numbers that I've got here, but just so you guys can have those for yourself. A small position on UNH, and the strike price was, let's bring it up here. It's just so tempting, Oliver. And that can get you into trouble. So I did the 300s. So I've got a long way to go. There you go. There's the red line is where we're at. So in order for it to get down to that price level, I mean, it certainly could absolutely do it. It would have to drop about 5.15% by Friday. And I think that that's certainly possible. You know, it looks okay now. But again, long term, I think that United Health is going to be okay. I think they'll weather the storm. You look at just how much it's oversold. I have asked Larry to check this one out for me from a fundamental perspective and see what's rotten in it. He hasn't had time to do that one yet, but at some point, this thing is going to be a screaming buy. So I'm dabbling with the people's fear monitor right now and playing off that by selling some puts at 300. The other one today, I did two. I'm very bullish on what's going on with Bitcoin. If you look at the charts here, we're going to be, I mentioned last week that I do believe we'll close this week at all-time highs, above all-time highs. And that all-time high, as you can see on the screen here, on the futures market is, oh, this changed. This is rolling. So now it says 110, 150. I don't know about that. But we did hit 107 today. Our high overnight was 107,530. I'm pretty bullish on this. I do think we're going to stall at all-time highs just for a second, but I do feel momentum is going to break through that. And for that reason, I'm long on IBIT. I sold multiple put positions today on MicroStrategy, and I did something a little bit different. I did two different trades on MicroStrategy today, and here they are. So let's go MSTR. And I apologize. I know some of you know the company's name is called Strategy today. I still call it MicroStrategy. So I wanted a higher rate of premium. Really, I was looking for very high rates of premium, and that's why I've been messing around with MicroStrategy so much. So I sold the 380 puts expiring this week. Now, does it get down to 380? It very well could. It was up 3% today. If Bitcoin has any weakness, no problem, Thomasine. Have a great day. If Bitcoin has some weakness, obviously MicroStrategy is going to take a little bit of a hit here and move to the downside. But I just technically and politically, I feel Bitcoin's going to continue to move up here. I think the worst is behind us, and we should see the start to trend up, maybe after a little bit of a pullback. So I did a bunch of weeklies at 380, and then I actually did a longer term, which I haven't really been doing with these types of stocks. I'll do monthly trades with the ETFs. So I'm looking for, more liquidity, more diversification, so I don't get caught. Well, I have the June 20th, so I went out a month here. And on that one, I did the 400s. So I'll put the blue line here as the 400 level. And I got great premium on this one. It was roughly 7.5%. So it'd be 7.5% for the month, which I'm okay with that. I know that that's very close to personal price. And I'm sure that, you have the 400s and 430s expiring Friday. I did the 400s, but I gave it another month. And for that, I got a very hefty rate of premium. It was like $26 per share, something I collected. I don't know, a little bit more than that, but great rate of return. And I didn't do a huge position. I only did 3 contracts at that one, so it's a smaller position for sure. But that way I just locked up for the next 30 days on MicroStrategy for 400. And if my thought is correct and it continues to move up, then it's a big nothing burger, and I get to keep that 7,000 plus in premium. Which is fine. I'm happy with that. Lisa said I sold the December 30 put on MicroStrategy earlier this month. Nice. December 30th, 370s. Yeah. And again, it goes back to the point. If you believe that this is going to continue on moving up, then you just sell puts along the way at levels that you're happy owning it. I've been doing a lot of trading with MicroStrategy, and the gut-wrenching part of it is just the volatility. Those of you who are in it, you know what I'm talking about. It's brutal. Damiani says, thinking about a 2027 leap. You could. You certainly could. You get a ton of premium for it, but I don't like that far out. I mean, yes, I do think Bitcoin's going to continue to move higher and higher and higher, but, well, anyway, that was the 2 positions there, and what else did I do? I just had the MicroStrategy. That was it. Oh, I had some orders on SMCI, but I canceled it. I didn't really feel comfortable with SMCI. Premium was actually fairly decent, but I think SMCI is going to end up closing this gap here. Their gap goes back to this May 13th closing price, which is $38.89, and the selling at the premium of that strike was not a not good. Oh, you're talking about, honestly, Damiani, for both of those, you'd be fine. You mentioned selling the leaps on UNH. Sure. You know, this one's very sketchy from the perspective of they don't have a solid leader, right? They've gone through a few CEOs now since their CEO was assassinated. There are allegations of fraud and all sorts of regulatory issues going on with them too, which could push them lower. I think right now it's just people going, I don't want that uncertainty, and I'm unloading. So I'm okay with it down at this one, these levels. Nope. Dakota asked that. Nope. Dakota's a Don Fron guy. I don't. I just like doing weeklies and monthlies, and that's it. So yeah, I don't do the poor man's cover call. There's a new yield curve section on TradingView now. Ooh, there is? Ouch. Let me check it out real quick. I haven't looked at that one. I got to go back to their home, right? I'll look at it later on today, but that'd be kind of cool. Those bond yield charts are nice. I like having them in there. And, you know, one of the things I've done with Bill is look at, let's go to futures, you know, adding in our own yield curve construction, because you can do things with formula in TradingView, which I'm a big fan of. If you click on, I have USD 10-year minus the 1-year. So this is what Bill says is the yield curve. Most of the industry will tell you that it's the 2-year and the 10-year. That said, we're still looking better and better, right? Drifting higher on that, which gives us a more better representation of that yield curve. And here is your 10 and the 2, which now has a 50 basis point difference between the 10-year and the 2-year, which is good. It's what it should be. The 2-year should be offering you less than the 10-year. 10-year should be offering you more. And again, if we get more defaults, guys, these credit spreads or the differences between your longer term and shorter term, they'll actually stay somewhat similar, but the long end of the yield curve should get higher and higher and higher, because the longer you commit to an uncertain economy and a certain political party, those yields go higher and higher. All right, top 8. Top 8. I think I had it all set to go, but our dollar index was your first victim on this one. You know, we talked about this repeatedly over the past couple weeks where, yes, I understand that we've got this long sideways chopping piece, but we've broken those lows, which is right around the 99, call it 100 mark, and we raced towards that little yellow box I had mapped out there between 98.32 and 97.69, and now we're bouncing from it. For me, no day trades today. No day trades. I'm really busy editing a whole bunch of videos for Trading Academy so I can get these videos up. So I'm the video production guy at Trading Academy, and I'm also one of the educators, and I'm also, yeah, I wear many hats there, Margaret. So unfortunately, no day trades, but I love my swing trades. For the week, it's a little less stress than having to go in there each and every day, but yeah, did not make any futures trades today, unfortunately. So as I was mentioning, we could put a moving average on this to define it, but it's very clear to see where this thing is going. At least since January, you're going lower highs, lower lows. That tells me, at least I believe, that we're going to see this continue on down and ultimately, over some window of time, break this low demand area that we've already hit. That'll be 97.69. If we get below that, you should see some pretty fast downside movements here. But you know, keeping with the trajectory, and it's difficult to create trend lines on a market chart like this because you can go through the bodies. That's going through the bodies, or you can go through the tails, which people like as well. Right, there's your tails. It's a very different trajectory if you go through the tails. Or if you go where it's called best fit, you'd have another trend line that looks like that. Either way, the trend is down. I don't think anybody can refute that. This trend is looking weaker and weaker. So wouldn't surprise me to see this kind of keep drifting lower until we start to make a new pivot high. Once that happens, then we can start being bullish again on the dollar. But remember, government wants it. Bob Dunn touch it, use the wicks. I think the key is you gotta pick what you use and stick to it. Everyone does it different. I go for the best fit among most points of contact. So in this case, I'm using the wick for sure on the high that we have from January 13th. But I feel like I get more points of contact here. I've got 1, 2, 3, 4 points of contact if I use that line. But however people want to draw it is totally fine. If you do the wicks, you get very different numbers. So this is where the wicks are, right? And maybe you use it once it breaks through this lower line. I'll color the code them so you guys can see what I'm talking about. Once it gets through that, there we go, through that down sloping blue line I have on your screen, then maybe I'll use the other ones. Big Heb, he says, I draw the trend lines so they match up with my bias. That's kind of true anyway, right? We go by what fits us the best. So there certainly might be a bias in there. But I do think you'll see this continue to drift lower. Today we saw that to the tune of 0.61%. Russell still kind of languishing at that overhead supply zone we've got mapped out. 2105 is the beginning of it. We went all the way through it, honestly, on the 12th of May, but have not closed above that 2,125 mark for the Russell, which is making me bearish on Russell. Your 10-year bond had a long topping tail day today, but it feels like we've changed course. That downtrend, which started back on January 13th, that was broken, I would say, back here on April 10th. Actually, April 10th. We pulled back, made a higher low, and now we're making higher highs. So keep your eye on that 10-year yield. It feels like we're going to slowly keep creeping up. And again, the downgrade here could help push those yields higher. Use the daily chart, nothing lower. Yes. And let's be clear, PB, you can use any time frame you want. I believe, and this is just my view, is that for me, in my style, the daily is the best way to go. The daily is the big picture. Now, you notice occasionally I do bring out the weeklies. I like to look weekly candle closes, and if I see shooting stars or hammers at certain levels, that might sway my thoughts on where the market may be headed. But I like dailies. I know other people, like Bob Dunn, he thinks if you use a 15-minute chart, you're a moron. He'll be like, you're an idiot using a 15-minute chart. Well, I disagree with that. I think everybody here has their own style. What I will tell you for those of you who look at the a 5-minute time frame or especially a 1-minute time frame, overall you're going to have a much harder time of being successful if you use a 1-minute chart because the moves are so erratic. You'll get stopped out way more than you normally do. So yeah, I like the daily for most of my broader analysis, PB, but don't get me wrong, I still go and look at smaller time frames while I'm trading and try to pinpoint and refine entries and exits. So yes, the smallest I'll look at is a 5-minute, but really I like the 15, I would say was more my execution chart. Marcus says inverse head and shoulders. Yeah, it does look like that, right? It's kind of tricky as to where you draw it, but you do have this left shoulder here, the head, the right shoulder, but this is real tough. Where do you draw it from? Do you draw it from there? That's not going to work. Do you put it there? Now we've modified this a little bit. It's tricky. I wouldn't call this a great representation of one. It's just too hard to draw and very subject to everyone's own interpretations. But yeah, it definitely symbolizes the same thing. Remember, what is a head and shoulders pattern telling you? It's telling you that if you're on the left shoulder and it's moving higher, we're still bullish. You make the head an even higher point, still bullish. And then once it comes back down on the neckline and tries to move up, let me see if I can get you a better representation here. I have one all set up for you, or had one all set up for you, I thought. What we were looking, there was one chart we were looking at a lot that had a perfect head and shoulders. I thought it was the Russell, but it's not. The time that it makes that left shoulder doesn't make a new high. And so all it is doing is implying weakness. Whereas if you look at this guy here, this is implying bullishness because it has not been able to dip and come back down to those lows there on that Russell. All right, 10-year yield. I already looked at this is a similar picture, right? You talked that inverted head and shoulders. This last dip that it had on May 1st didn't come anywhere close to the lows of April 7th. So that is showing you strength in the 10-year yield here. Obviously, that'd be weaker for the price of those bonds. So this is a short TLT kind of moment for anybody who's looking for bond ETFs to trade. You've got a very bearish picture on TLT. And in my opinion, I think you're going to see TLT drift lower. You'll probably see it come back down to these lows from October of 2023, around 82.60, 82.70, somewhere in there. Let's see. I'll get to the top 4 here in just a second. Chad says, shouldn't trend lines be used for support and resistance and moving averages for the trend's midline? Trend lines indicate potential targets while moving averages smooth price for the trade's center. There's merits to both of them, right? Moving averages are dynamic and they're going to constantly be adjusting to whatever price is doing. However, drawing in a linear path, a straight trend line, has worked many times for me where I'm in something, I go, oh, it's gonna turn here. And that point, as it comes back up to a trend line, for example, it may not coincide with a previous supply or demand zone. So doing a horizontal line doesn't work all the time. Trend lines just add one extra little calculation, one extra variable. And I could very easily go to something that, if you go to, let's go to that Russell, since we were picking on the Russell here. I'll go to where I think I have most points of contact, right? For me, that tells me that the Russell right now is literally at it. And I'm going for the peak there on November 25th last year. You can see right here, we hit it. We're close right at it. We hit it again on the 18th of February, and now we're back at it. So that, to me, is going to be a much better representation than if I put on something like a 20 or 50 period moving average. So let me put on a different moving average. All right. The moving average right now is telling me potentially buy it because it's turning. You can see that it's starting to curl up on this moving average, which I'm assuming it looks like a 20. That's a 50. Let's go get the 20 on there. So the 20 is already curled up significantly. It should be ripping to the upside. Right? So you're getting a buy signal, or got a buy signal about 2 weeks ago on the moving average, 20-period moving average, whereas the trend line is now telling you you're hitting overhead supply. You're also in supply zone. So based off that, this is misleading. Right? This is misleading because the moving average is saying to buy it and stay long, whereas the other two indicators we have here, trend lines and support and resistance, or supply and demand methodology, are saying we're probably going to stall from here. So I will take the short opportunity. I think that's probably the highest outcome here, and it has to do with several components. Again, overhead supply as well as that downtrend line. So, and as Big Eb mentioned earlier, there's a phrase that says if you torture a chart long enough, it'll tell you whatever you want to hear. Very true, in my opinion. You can sit there and look at price charts and you'll convince yourself to do all kinds of crazy things when, if you just follow your same simple rules. For me, I always draw my trend line from that apex point or the lowest point, and then I go through the most points of contact, and that's where I keep it. So Russell's great representation here of that downtrending trend line. Whereas Corey Lane and Don Dawson, Don's a little shy. Don doesn't really like to come on, and Corey Lane is a busy guy. I also, because of my loyalty and now refound, I guess, exuberance of Trading Academy, I don't really want to bring on competing schools. I think hopefully you can respect that, Margaret. I in the past, I'm like, hey, you go where you want. But I certainly to this day think you should go where you feel best taking classes and going to school. But bringing on competing education companies, I'm kind of feeling that's not good for me to do. Right? Don should be okay. I'll reach out to Don. The one I've been wanting to get on and I keep forgetting to ask him is just Scott McCormick. Scott McCormick should be on once every few weeks. He's got some phenomenal analysis of markets. I love it. I'm sitting here a lot of times. I feel like I'm on your end just watching the chat and going, oh, yeah, what about this, Don? What about this? He's so good. So, yeah, I'll try to bring on more Trading Academy instructors, but that's the general with Margaret. All right, we already looked at that 10-year, but 10-year right now, similar picture, making higher highs, higher lows. I'm bullish on the 10-year. NASDAQ 100, another bullish day. It was just barely up at 0.1%. It did breach this overhead supply zone and closed out of it. So I'm taking that off. That's officially done for me if it closes outside of that range. Now you're just looking at the last big move, which happened kind of at the peak there. And I'll put a yellow rectangle on that one as well. And it's not going to let me draw this line out. 1 second here. I have to do some little doctoring here to get this box to go any further out. Kind of annoying, but let's go draw that from there to there. So that puts your NASDAQ 100 at, the zone is 22,224 up to 22,319. All right, so that's my overhead supply zone for the NASDAQ. It might hesitate and take a little bit of a breather. I just think that the markets have been long in the tooth and take a little breather before it challenges that all-time high there on the NASDAQ. Now your S&P 500, similar picture. We've broken above that little yellow box that got mapped out, no problem. Now we are still above that yellow box. Question is, where does it go? Well, you have that 6,000 number. Let's put a 6,000 on here just so we can have that one. Bear with me, and we'll make that, what color do you want the 6,000 mark? It's red. All right, convenient. I'll put a green because it's a target. Okay, there, and let me modify that to 6,000. All right, so now you have this 6,000 mark on there. It's in green. That's your next logical point. And today we got pretty darn close to it. I mean, our intraday high for the S&P was 59.87.5. So 12.5 points away from that level. Pretty darn good. Again, I think there's going to be a small pullback. Maybe dropping down to 58.36. But there you go. Tim says, what about Jordan Brock? Taylor Frame would be great. Yeah. The tough part is, Tim, some of them that you mentioned are great teachers. Phenomenal teachers. They don't want to be on camera. They don't. Trust me, I've asked several of them to come on, and there's several others on that you haven't mentioned. They just don't want to be on camera. I'm like, well, we'll just put up a fake AI-generated picture of somebody else, right? I'll put Fabio's picture up and say, oh, this is so-and-so. And no, I just don't really feel comfortable in it. So I've asked. I've definitely asked, and I will continue to ask them. I think you guys should, see all the different stable of instructors just so that you can, there's certain people you resonate with, right? You're like, God, I really like the way this person talks or teaches. And if that teacher comes to your center, well, try to jump in there and get a seat for that class so you can learn from someone that you resonate with. That's true. Scott McCormick does use a picture. He does not want to be live. He's so funny. I'll work on it, guys. I'll work on it. Top three, crude oil, 0.27% gain for today. We've got that line drawn at $64, which is kind of where it's been stalling out and having difficulties. As I've mentioned for months now, my bias is still to the downside here on this one. This is not a trend line, by the way, but if I were to draw that trend line, we could draw it. Yeah, that's tough because I like to go through the peaks, but all right, I'll leave that there for now. I may tailor this in just a little bit. Does not want to be a celebrity? Yeah, a lot of them don't like to be celebrities. Margaret, I'll go to Fabio's class. Margaret, we make our instructors wear shirts when they teach, okay? Don't get all too excited here. There's no, we have hand sanitizer by the door. That's not baby oil, Margaret. All right, Bitcoin was our second place finisher today. 1.39%. Now that's moving up in the after hours. It didn't close up that high, but it's slowly ticking to the upside here. Again, I think we're going to be above all-time highs by the end of the week. Woo, woo. We'll see. It's up $1,400 per Bitcoin today at 105,880 as we speak. And then the risk-off asset, gold, continuing to do okay. Even though it's stalled, I've got that little yellow box drawn on your screen, and it's definitely proven to be a challenging point. If we get above 3270, then I believe we'll be at all-time highs in a very short order. But right now, it just feels like it's struggling to find its footing. Anything from a geopolitical announcement to Jamie Dimon's press conference talks could cause this thing to go wild in one way or another. So fairly flat and uneventful right now, at least for the past 5 trading sessions. But all in all, that was your best performer. 1.45% gain today for crude or for gold. Okay, earnings calendar. We had really nothing on the slate for today. We had some FOMC people speaking. Tomorrow does get a little bit busier because you do have a rate announcement for Canada, and that's going to happen 30 minutes after the markets, after midnight. They're expected to drop 25 basis points. Of course, this is going to be Eastern time, so 12:30 a.m. is when they'll come out with their rate announcement. And again, rate cuts typically hurt a currency. So if you look at something like the Australian dollar, which let's bring up my Forex page here. Let's go to AUD USD. There it is. This is the daily of it. It's really just been stuck. It feels like, a month worth of trading has really been stuck in this tiny little range here on the Australian dollar. So cutting those rates should have a downward impact. It's interesting we go all the way back here. Should have a negative impact on it, but we'll see. Maybe that one's already priced in at 25 basis point cut, getting down to 3.85. Other than that, for the U.S., you got more FOMC members speaking, and a lot of them. You've got Barkin, you got Bostic, you got Masalam, you have Kugler, you got Daly, you got Hammock, all speaking tomorrow. And that's pretty much it from the big trade data piece. Ask Burry why he dumped everything. Now, I think he got lucky with his big short thing. I don't know. Everyone makes him out to be this amazing trader, but it seems like when he talks about something and I'm doing this or doing that, the markets do the opposite and he ends up being a big loser. But Michael Saylor's brilliant once again. He's brilliant when that stock keeps moving up. As long as Bitcoin keeps moving up, he's going to look like a prophet. I'm going to walk on water in many people's eyes. And I'm okay with that because he'll have boosted my portfolio, which I'm okay with that. You can keep on pushing those prices higher. So that was your economic calendar. On the earnings front, there really isn't a lot of important companies reporting earnings tomorrow or this week, but there are a couple of, I will say, quasi-bigger names. There was nothing today, but here's your earnings calendar for tomorrow. we talk about retail sales numbers being up, but not as much as expected. Actually, it was decent, right? We saw a decent number for retail sales. It wasn't as bad as they had thought it was going to be. You have Home Depot, Palo Alto Networks, you've got Vodafone, Keysight Technologies, Toll Brothers are some of the bigger names out there for the market. Is snow tomorrow? Snow is, it's not tomorrow. Was that today? I'm sorting my market cap here. Yeah, that's what the doctor said. Doctor said physical therapy. I think snow's coming up this week, but I don't think it's, there it is. Snowflake is on Wednesday. Yeah, not tomorrow. All right, that's going to do it for me, everybody. I'm going to wrap up. I'm going to go and put some more ice on my bag. No problem, Tofi. I knew it was coming out this week, but you had me started. I was like, I didn't miss that one, did I? Snowflake, you know, when it first came out, you guys knew my thoughts on it. I said short that damn thing. It's going to tank, and it did. I said we'd be sub 100 in a short window of time. We actually got pretty darn close, and this is back when we peaked out. I did think we'd get below 100, and we did not. We got to 109 and change, but how's the picture look now? Still doesn't look that great, in my opinion. It doesn't look that great, in my opinion, because you've got just nothing but consolidation from all the way back in May of 2022. So we're talking 3 years that it really hasn't had a breakout big move. It's looking great right now just because of the overall market is pulling it up. Really, the breakout point's going to happen when you start filling this gap, and that's going to happen right around 193 bucks. So there we go. All right, everyone, that's going to do it for me. Hope you enjoyed. Hope you learned something along the way. I'll reach out to some instructors. I actually have a conversation with some of them tonight. So if I can coerce some to come on this program and talk to you guys, I'll do my best. So if you guys have something you want to talk about for tomorrow, email me. Let them know. Let me know. Whatever you want to talk about is usually fair game here. TraderMerlin@gmail.com is where you would send your questions to. That said, have a fantastic remainder of your day, everybody. I will see you mañana.